This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. Today we are exploring one of the most powerful forces in every economy, a force that silently changes the value of your savings, your salary, and your future. Today we are talking about inflation. Most people think inflation simply means prices going up. Food becomes more expensive. Rent increases. Fuel costs more. Life slowly feels harder. But inflation is not just rising prices. It is a change in the value of money itself. When inflation happens, each unit of money buys less than before. Your salary may increase, but if prices rise faster, you are actually becoming poorer in real terms. Your savings may stay the same in number, but they lose purchasing power over time. To understand inflation, we must return to how money is created. In modern economies, most money is created through credit. When banks issue loans, new money enters the system. When loans are repaid, money disappears. When credit expands quickly, the money supply grows rapidly. More money begins chasing the same amount of goods and services. When demand rises faster than production, prices move upward. This is one of the core drivers of inflation. But inflation is not caused by one single factor. It is the result of several forces working together. One major cause is excessive money creation. When governments and central banks stimulate economies by lowering interest rates or injecting liquidity, borrowing increases. This boosts spending, investment, and consumption. In the short term, it feels positive. But in the long term, it often leads to higher prices. Another cause is supply limitations. If goods become harder to produce due to shortages, disruptions, or rising production costs, prices increase even without new money entering the system. Energy shortages, transportation problems, wars, and natural disasters all reduce supply. When supply falls while demand stays strong, inflation rises. Inflation can also be driven by expectations. When people believe prices will rise, they behave differently. Consumers rush to buy before things get more expensive. Businesses raise prices to protect profits. Workers demand higher wages. These behaviors themselves push inflation higher. This is why inflation can become self-reinforcing. Once it starts, it can accelerate quickly. Central banks attempt to control inflation mainly through interest rates. When inflation rises too fast, central banks raise rates. Higher rates make borrowing more expensive. This slows down spending, investment, and money creation. When inflation falls too low or economies slow down, rates are lowered to stimulate activity. This balancing act is extremely difficult. Move too slowly and inflation gets out of control. Move too aggressively and economies fall into recession. Inflation is not always bad. Moderate inflation is often considered healthy. It encourages spending and investing instead of hoarding cash. It allows wages to adjust. It helps economies grow. But high inflation destroys stability. When inflation becomes severe, savings are wiped out. Planning becomes impossible. Trust in money weakens. History shows many examples of inflation spirals destroying entire economies. In extreme cases, money becomes nearly worthless. People rush to exchange cash for goods immediately. Prices change daily or even hourly. While modern economies are far from such extremes, the underlying mechanism is the same. Inflation is always about money losing value relative to goods. For individuals, inflation quietly transfers wealth. Those who hold mostly cash lose purchasing power over time. Those who own assets like real estate, stocks, or businesses often benefit as prices rise. This is why wealthy individuals tend to invest rather than hold large amounts of cash. Inflation rewards asset ownership and punishes idle money. This is one of the most important realities of modern finance. It explains why saving alone is often not enough to build wealth. It also explains why long-term investing is so powerful. Over time, strong assets tend to outpace inflation, preserving and growing purchasing power. Another important effect of inflation is on debt. Inflation reduces the real value of fixed debt. If you borrow money today and inflation rises, you repay that loan with less valuable money in the future. This benefits borrowers and hurts lenders. Governments with large debts often benefit from moderate inflation because it slowly erodes the real burden of what they owe. However, when inflation becomes too high, interest rates rise and debt becomes more expensive to manage. Inflation also impacts wages unevenly. Some salaries adjust quickly. Others lag behind. This is why inflation often feels unfair. Prices rise immediately, but income increases slowly or not at all. Those with fixed incomes suffer the most. Understanding inflation changes how you approach money. It explains why long-term financial planning must include investing. It explains why emergency savings should be protected but not oversized. It explains why assets matter. It also highlights why financial education is essential. Without understanding inflation, people believe they're progressing financially while actually losing ground. They see higher numbers in their bank accounts without realizing those numbers buy less each year. Inflation is invisible but powerful. It does not announce itself loudly. It slowly reshapes economies. Every financial decision exists within this reality. Saving, investing, borrowing, spending, and earning are all affected by inflation. This is why understanding how inflation works is one of the foundations of financial literacy. On Capital Clarity, we aim to remove confusion and replace it with understanding. Inflation is not a mystery. It is a predictable result of money supply, demand, and human behavior. When you understand it, you can make smarter decisions. You can protect your purchasing power. You can build wealth over time. You can avoid common financial traps. Money is not just what you earn. It is what you keep and what it can buy in the future. And inflation quietly shapes that future every day. On Capital Clarity, we will continue exploring how money really works. Clearly, simply, honestly.